Hello, guys. Nice to see you all. Nice to see you back here. Welcome back to another episode of this mentorship or series or whatever you want to call it. You know that here we cover essential trading concepts from candlestick psychology to liquidity manipulation by institutions. But technical knowledge alone isn't enough. Trading success also depends on psychology and discipline, which is why we must integrate smart strategies with a solid mindset. And here's the thing, one of the biggest mistakes traders make is overtrading. To stay profitable, you should never take more than 2 trades per week. Patience is key. Wait for the setup to form before entering a trade. Chasing random moves will only lead to unnecessary losses. The fear of missing out, or the FOMO, fear of missing opportunities, is a trader's worst enemy. It tricks you into emotional decisions which often result in bigger drawdowns. Risk management is another critical factor that you need to consider. If you have a $10,000 account, your stop loss should never exceed 2% per trade. That's a $100 max risk per position. If you lose that amount, walk away, have a beer, and wait for the next valid setup. Trading is about protecting capital while ensuring your wins outweigh your losses. Let's break it down with a simple example. If you win 5 trades, each hitting a take profit of $300, that's $1,500 in gains. And now, if you lose 5 trades with a $100 stop loss each, that's 500 in losses. Even with a 50% win rate, you would still profit 1000 monthly. This is the key to long-term profitability. Trading is about winning every trade. Isn't about winning every trade, sorry. It's about managing risk and ensuring that your winners outweigh your losses. And remember, revenge trading is a bitch. It's like texting your ex after 3 drinks. Just don't do it, man. Now, what are swings in trading, you're asking? That's the theory that we're gonna cover today. This is another key concept that we need to understand before to get our first trade. Daily swings are easy to identify and hold significant influence in the market behavior. Swings follow a three-candle pattern where the PO3, that's an IDT concept, the PO3 framework is applied. PO3 represents the natural flow of price delivery and reveals the market cycle. Liquidity is created. Orders accumulate at key levels. That's where the liquidity is. Then the manipulation occurs. Institutions sweep liquidity, triggering stop hunts. And then the price is distributed. The market moves in the intended direction for institutional profit taking. These dynamics define institutional trading where price does not move randomly, but follows deliberate sequence orchestrated by major players. Okay, think of smart money as a magician. It makes your stop loss disappear in thin air and leaves you wondering where your trade went. Now we're gonna integrate a concept that is called AMD, integrating AMD with swings. The accumulation, manipulation, and distribution (AMD) process ties seamlessly into the swing pattern, offering traders a structured method to interpret price movements. It's almost the same. Accumulation, liquidity builds up as the traders place orders within a range. Manipulation, smart money exploits liquidity pools by triggering stop loss orders. And then the distribution. Institutions push price toward their targets, closing positions profitable. If you see this this graphic here, we can see this square here. It's the accumulation. Then we have the manipulation that takes the liquidity from this place here down on the square. Takes the liquidity once it goes through, and then we have the distribution that takes all the liquidity we have. And by understanding swings, traders gain deeper insight into how liquidity is accumulated and subsequently used against the market participants before being distributed in the opposite direction. Simplifying swings into a core trading setup, in a sense, is indecision, reversal, and impulse. Sounds familiar? Ring a bell? This is our setup. This is our swing. This is our profit. Mastering this setup equips traders to anticipate institutional moves, avoid liquidity traps, and refine entry strategies with precision. Yeah. Institutional manipulation in accumulation phases. During an accumulation phase, market participants tend to place their stops orders above resistance or below support levels. Institutions exploit this behavior by triggering liquidity grabs in one direction before the reversing course, taking out the stops on both sides, here and here. And this is the first take of the stops, and this is the second. Well, the swing structure breakdown, it's the first candle that represents indecision, orders accumulate without a clear directional bias. The second candle, the reversal candle, indicating smart money's shift in momentum. And the third candle, the impulse candle, confirming distribution and final price movement. Let's see one or two examples of this in the chart. Well, we're now in the chart. Let's see about one example here. This seems pretty good. Okay, let's check in 15 minutes. Okay, we have this example here. If you see here, we have the accumulation. All this is an accumulation of orders. We have stop loss here in the top and down. Then we have the manipulation that takes the liquidity from all these stop losses. Okay, give me a second. We have the manipulation here to take the liquidity from all of these stop losses, and then we have the distribution that comes here. Accumulation, manipulation, distribution, AMD. If we see this in a 4 hours time frame, just a few seconds. Where it was? Okay, here. If you see this, we have our setup here. It's our setup. Look at this. We have the indecision candle. We have the reversal candle taking liquidity from this indecision candle, and then we have the impulse candle taking the other liquidity of the indecision candle. That is how AMD works. This is how P of 3 works, and this is how our setup works with this pattern. You see, we have, I'm gonna look at this. Look, this is our pattern. This is our indecision candle. This is our reversal candle that takes liquidity from this. Here you can see, here you will find a stop loss, and our reversal candle takes the liquidity from this side of the indecision candle. Then we got the impulse candle that takes the other liquidity of the indecision candle, and that's how we have the AMD also and our setup. Accumulation here, accumulation here, manipulation, and distribution. That's how it works. Now, an important clarification. While accumulations occur within a range itself is not an accumulation. It merely provides the conditions for liquidity build up. If you ever feel lost in trading, just remember, the banks already know where your stop loss is. They're basically playing hide and seek with your account balance. To validate whether a swing high or low is legitimate, follow these 5 key steps. First, there needs to be a presence of an SMT, smart money technique, or smart money tools, divergence, whatever you want to call it, confirms institutional involvement. We're gonna have a class about SMT in the future, so stay tuned. The second step is that the reversal candle must take out a previous swing, a prior level where stop loss orders are concentrated. Mhm. Or, where when the reversal candle takes the liquidity from the indecision candle, that's where in the low side of the indecision candle, that's where usually we have another swing, but in a lower time frame. The third step is the must engulf the previous candle, demonstrate liquidity absorption. You know what is happening. Also, the indecision candle is taken by the reversal candle. That could happen in a different way from the step two because it's supposed that if you see on the left, needs to be another swing, but also for the third step, needs to get the liquidity from the first candle. And the fourth step is must form within a valid POI, a point of interest. This includes reaction zones, order blocks, or inefficiencies. The back or the down, the both side of the reversal candle needs to be support in a valid point of interest. You know, if you see on the left, you'll need to see that this part of the candle is support in an order block or inefficiency or any point of interest. And the fifth step is must align with the overall trend context. You need to see the trend, ensuring market structure supports the move. The critical rules are steps 3, 4, and 5. Must always be met for a swing to be considered valid. The last three steps, it's a no negotiation. That needs to happen if you want to confirm the swing high or the swing low. And that's it, guys. These are swings, PO3, and AMD are fundamental to understanding the smart money behavior in the markets. By recognizing how institutions create and manipulate liquidity before distributing price in the opposite direction, traders gain an edge in identifying profitable opportunities. This episode is just the beginning. Stay tuned for more insights as we build your trading mastery step by step. And remember, trading is the only job where doing nothing is a strategy. So sit tight, wait for your setup, and let the banks do the heavy lifting. Stay safe, guys, and remember, if you want some ebooks or courses that teach these things, please check the link in the description. Peace.